TD Securities has provided the most accurate foreign exchange forecast in the world, and it is predicting that the euro will reach parity with the dollar by next year. Because of the track record, the firm is a Bloomberg best. It's posted the most accurate overall currency forecast over the last 6 quarters. Shaun Osborne is the chief currency strategist at TD Securities. He joins us now from our Toronto bureau. Shaun, great to see you. So the euro has enjoyed slight but still some gains of late, yet you're still calling for parity against the dollar. Why such a bearish outlook?
Yeah, we don't think really the last couple of weeks really changed that much in the overall dynamics of what's going on. We probably are seeing a bit of a correction in the euro. We've come a long, long way very quickly in euro dollar, in particular over the course of the last couple of months. And I think really what we're seeing right now is just a consolidation of that move. I don't think it changes the underlying trend at all. And as I say, the underlying dynamics of this move, I think, are still really quite negative for the euro from a longer term point of view. So we may see perhaps 128, 130 in euro dollar over the course of the next couple of weeks, maybe a month or so. But beyond that, particularly in the latter half of this year, the latter part of this year rather, we think the euro is going to continue its decline.
Now, recently, we've got another round of really upsetting U.S. economic news. The jobs report, even the services report today was lower than forecast. The U.S. dollar's been under some pressure. So why isn't that more supportive to your euro outlook? Why isn't that, helping the euro continue to appreciate?
Well, I certainly think the U.S. economy is going through a bit of a rough spot at the moment. We don't think, although perhaps the risks may be rising of a double dip and perhaps even renewed stimulus action from the U.S. authorities, we don't think we're anywhere near there yet. And in fact, at the moment, in terms of our forecast, we still think the U.S. is going to have a fairly significant growth advantage over the Eurozone in particular as we move through 2011. For the Eurozone overall, we don't expect growth much more than 1% for 2011. And for North America, for the US in particular, we expect growth to be in the region of 2.5% to perhaps just under 3%. So there will be a fairly significant growth advantage, we think, for the US economy, regardless at the moment of this soft patch that we seem to be going through.
Back to Eurozone, the European Central Bank has been buying bonds in an effort, obviously, to support these troubled Eurozone economies. Why isn't that factor more supportive to your euro outlook?
Well, I think as we saw in 2009 in particular, it was a case of sort of punish the printers, the banks that were central banks that were undertaking quantitative easing were hit quite hardly, or the currencies of those central banks rather were hit quite hardly. So the European Central Bank is undertaking, I guess, its version of quantitative easing at the moment. Is buying government bonds. It's trying to sterilise those purchases in the market, but essentially it means that the European Central Bank is essentially easing monetary policy at a time when other central banks are trying to get away from softer, easier monetary policy.
Do you think this $1 trillion aid package is enough?
It may be enough for the moment, but I'm not at all convinced that we're going to get through this Eurozone financial or fiscal crisis without some sort of, particularly for the weaker Southern European economies, some sort of perhaps debt rescheduling at some point. So I think there is perhaps the need, or there will be the need further down the road for more support from the IMF and the European Central Bank, or the SPV as the stabilisation fund will become. But at the moment, I think it's probably adequate. It is still a very significant challenge, though, I think, for those economies, not just fiscally, but they've lagged so badly in terms of trying to control domestic wages and prices that the need to become more competitive really requires a very significant period of essentially deflation in those economies, which is going to be quite painful for a good chunk of the Eurozone economy. And that goes a long way to explain why we're really quite negative on the growth outlook for Europe next year and potentially even beyond that.
What is your worst case scenario? We've been covering all of these sovereign debt credit downgrades. We've talked about the $1 trillion aid package. Do you think ultimately one of these sovereigns will default?
I think worst case will be a kind of disorderly default, but if you listen to what some of the senior European officials are trying to move towards, I think is a mechanism for an orderly, perhaps, default of some of these countries. I don't think we're there yet, but if you look, for example, at the way the credit default swap curve for Greek government debt is trading at the moment, that's implying a fairly significant risk of a default.
Hey, Shaun, can you explain to me the difference between a disorderly and an orderly default?
Well, I guess one that doesn't surprise us, and one that is managed and undertaken by with some sort of orderly process involved, as opposed to a disorderly default which just comes up and surprises the market, something like Argentina or Russia in the past few years.
Very good. Appreciate that. Shaun Osborne is the Chief Currency Strategist with TD Securities. Thanks again.
Thank you.
And we